Hey guys, what's up? Welcome to another episode with me, Shashank Udupa. And in today's episode, I'm going to talk about my portfolio allocation for the year 2023. Why am I doing this? Is because if you look at the current market situation, it is very dicey. You can't exactly say that we are in a bull run or in a recession. We're definitely not in the bull run, but we're definitely not in the recession or anything like that as well. So now I'm changing my allocation and I'm going to tell you how I was allocated in 2022 and how I'll be going towards 2023 with my logic and reasoning. So let's get into the main part of the video. Now in 2023, my main goal is to focus my bets from a very high alpha generating return strategy to more of a capital protection with less alpha strategy, right? So what do I mean by less alpha and more alpha? Basically in the last 2 years, I was optimizing for more returns because obviously we were in a bull run. And now since the bull run has gone down and we're not in the bull run anymore, I'm going to focus on protecting my wealth as much as possible, but also get slightly more returns from the market as well. So what I'm going to do is I'm going to tell you 4 or 5 different asset classes that I'm investing in, how much I'd invested before and how I'm changing it right now. So the first asset class that I'm going to talk about is the stock investing strategy. So guys, earlier in 2021-22, my major allocation was in stocks. I had up to approximately 75% in stock allocation. So I was over leveraged on the stock market, mainly because my returns were also coming really well in the stock market, right? But now what I'm doing is I'm reducing my allocation from the stock market, which is direct stock allocation. I'm not talking about mutual funds. Direct stock allocation, I'm reducing it from 75% to this year, I'm making it 60% in 2023. Now, how am I changing my allocation here as well? I'll let you know, right? I'm putting 20% approximately in large cap stocks, mainly because I'm still young and I can afford to take a slightly riskier play. So I'll be taking more riskier plays in maybe mid cap and small cap, but large cap exposure I'm definitely going to keep. And why is that? Because if you look at the market that has corrected in the last few months, it has come down quite significantly from its peaks, right? But there are companies that are still doing fundamentally strong and still doing fundamentally well. So I'm keeping a 20% allocation in large cap stocks, approximately 50% allocation in mid cap, which is going to be my most sizable allocation right now, and around 30% in small cap. Now, small cap is going to be my most riskiest element, and usually small caps only perform as a cycle. Now after 2-3 years they might start performing really well, but mid caps, usually I'm trying to find companies that are in the mid cap space which will become multi-bagger long term large cap stocks, right? And large cap also I'm keeping 20% allocation. Why? Because I want to keep that stability in my thing. As I said, my whole focus this year is going to be on stocks allocation, which is mainly capital protection instead of just growing with maximum returns. So I'm going to do capital protection with little bit of alpha. So now with 50% into mid cap and 30% into small cap, I'm generating a good amount of alpha as well with 20% into large cap. But my overall stock portfolio I'm reducing now from 75% down to 60%. Now there is another thing that I'm doing in the stock market, and that is small cases, right? Let me show you what I'm investing in small cases. Now this is only going to be 5% of my allocation. Earlier I used to invest in a lot of paid small cases, then I started doing my own small cases. So you can do either paid small cases as 5% or you can do what I'm looking at as well, right? So let me show you what I'm usually planning to do, mainly on the small case side. Now with the theme of generating small alpha with capital protection, I need something that is stable and will not keep moving too significantly, right? So only 5% allocation I'm doing, but I'm doing a 5% allocation in 2 different portfolios. One is all weather investing, which has, I'll show you the ETFs and weights over here. So if you see the ETF and weight, mainly it talks about India's growth story only, right? So it's just going to invest in India Nifty ETF, which is the Nifty index that is investing in, and Nifty India ETF Junior Bs. So most of the allocation, as you can see, 40% is still, unmasking the entire equity index itself. 24% automatically is going into debt over here. Now I'll tell you why this is interesting, because this is also fixed income. So I'm investing in debt also, and I'm taking a small allocation into gold. Now if you actually look at this, right, even though these allocations are like this, you will see that compared to each equity, large cap and all weather investing are almost pretty much the same. So however the market is moving, which is in an upward direction, which will move in an upward direction tomorrow, because I'm doing direct stock investing with my 60% of my portfolio, I want like a mutual fund kind of a basket which is invested here as well. So this is what I'm doing now in 2023. I'm keeping a 5% small allocation in this, and I'm also generating another 5% allocation, which is to total 5%, so 2.5 into equity and gold. Now there is also significant gold that you saw, which is already there in all weather investing. So now you can take a bet, but I'm not going to go too deep into okay, how much gold is here, how much gold is there, mainly because I just want this to protect my wealth, right? So if it becomes very volatile tomorrow and the market goes goes really bad, maybe because of some new thing that comes into the market, or maybe a black swan event, this is something that will sustain my portfolio and not consider it a significant downgrade, right? So I'm trying to reduce my drawdown right now in the entire market and try to ensure that my stock portfolio doesn't go down a lot. When the market starts changing and the market starts turning and we go back into a bull run, I will remove the allocation from these small cases and invest in something which is better, right? Which is like better small cases or paid small cases or momentum small case strategy. There are many more in the market. So I'll be doing that. But for now, only 5% allocation is being done in this avenue. Next, we have gold. Now, gold is something, as you might have seen in the last part as well, I spoke about gold investing. Now, gold is something I'm increasing my allocation. Right now, I've done 60% into equity and small equity, 5% into small case, so 65% is over. Now, earlier my gold portfolio was only 5%. Now I'm increasing my gold portfolio a little bit by 10%. Now there are 2-3 ways that I'm doing this. One is by buying sovereign gold bonds slightly at a discount, right? That is also something that I'm doing in the secondary market. Number 2 is I'm buying gold on small case, which is the equity and small equity ETF. Gold ETF is also there, so I'm doing that. And apart from that, I'm also buying physical gold. So I'm doing all three, right? Yes, physical gold, obviously I'm paying multiple different charges, so it is not very beneficial, but I'm keeping it as a safe haven right now, right? Also because I'm married and my wife insists that we have some physical gold at home as well, so I'm automating my physical gold via credit card. So every time I have credit card spends, I usually go and buy Tanishq vouchers or buy any gold jewelry brand vouchers and buy not gold coins but maybe buy physical jewelry that my wife can wear as well. But it also acts as an investment piece for me going forward. But gold I'm increasing now from my earlier 5% allocation to now a 10% allocation, again because I'm already leveraged on the stock market with 60% allocation direct stocks, mainly into mid cap and large cap, and gold I'm investing from 5 to 10, and small cases which are going to just hedge my portfolio and grow as the market is growing. If Nifty grows by 10%, that will also grow by 10%. So that is what I'm doing right now, and gold right now is doing well. So why am I doing gold? Mainly because if the market does take a U-turn, then gold usually tends to start going higher, right? So that is why I'm doing gold right now. Apart from this, this is something that I've been the fourth investment that I'm talking about, which is something I've been talking about from a very long period of time, and I wanted to increase my allocation and I've done it right now, is fixed income instruments. Now fixed income instruments like bonds, okay, fixed income instruments, there are mutual funds as well. Now this is something that I'm increasing a lot this year. Now earlier I used to have only a 5% allocation, but now I'm upping that 5% allocation to almost a 10 to 15% allocation right now into fixed income instruments. Slowly I'm buying stuff that gives me 10% or 11% post-tax returns, or even if I get 9.5 to 10% post-tax returns, which beats my FD obviously and beats my inflation and is rated at least AA minimum, not AAA but at least AA. I'm buying these type of bonds and keeping right now. Why? Mainly because of capital protection. So this is not bad, because see, gold gives me some kind of returns, maybe 7-8%. Fixed income instruments might give me 9% post-tax as well. Then my stock return portfolio might give me anywhere between 12 to 15%. So overall, if I have to mask everything, it should come around 12% until now. But there is another thing that I'm also investing heavily into this asset class, which is the next asset class that I'm going to talk about, which is basically US stocks. Now, why am I investing in US stocks? Because if you look at the NASDAQ chart right now, and if you've seen my other videos that I do on every Saturday, right, you will see that NASDAQ is now slowly coming back into a recovery zone. Yes, they have been in a downward channel for a very long period of time, but I'm taking good positions into the US stock market. Earlier I only had 5% exposure. Now I'm increasing that 5 to 10% exposure. Now this you can have by doing either direct stock investing, or if you don't understand how to do direct stock investing, no issues, you can even just go buy simple US based mutual funds as well in the market. But please understand and see which companies that they've invested in, and only then take a call, and also look at the expense ratio while buying this. But now if you spread this across for the next 3 years, this is a good strategy to start going on for the next 3 years, right? Why? Because the next bull run might not happen tomorrow or day after. It might take a year, 2 years, 3 years to happen, or we might go into a strong positive momentum after 2-3 years. So until 2-3 years, I'm trying to save as much wealth as possible and generate slightly more alpha. So the two things that are generating good alpha for me are, one is my stock portfolio, which is going to give me anywhere between 12 to 14% is my average, and US stocks, if again I invest right now and if I'm assuming that this is a good time to invest and it starts again going up, this will again give me a 15% gain is what I'm assuming right now. So totally my direct stock investment portfolio would be maybe 60 which is stocks, 5% which is small case, and 10% which is US stocks, which is 5 to 10, 10% approximately is US stocks, which is approximately 75% right now. Another 10% I'm keeping in gold, which is around 85%. Another 10% which I'm doing in fixed income instrument, which is around 95%. And finally 5%, what am I going to do, right? Now this is very interesting because I was always thinking 5%, where do I do it? Should I do it in other asset classes, maybe crypto or something else? But I'm going to start keeping 5% directly in the form of cash. Right? Yes, I'm not going to do anything with this 5%. I'm just going to keep it in the form of cash, only to keep for deployment reasons. If the market crashes significantly tomorrow, I will have enough allocation now to start deploying into the market. So 5% is going to be in cash. But is this cash going to be in just liquid form in my savings account? No, I'm going to have a sweep in, sweep out kind of a facility, which is a fixed deposit. So every time it is going to be in a fixed deposit. Whenever I withdraw it, it is going to break that FT automatically and take it out. Whenever I deposit more than a particular amount, it is going to go automatically into that FD. So every time that money is in my bank account, it is going to earn interest. Yes, the interest is not something significant, the interest is not something great, but it is money making money. So my mental peace is going to be sorted. So this is a very simple strategy that I'm using right now. Mainly what I've done is I've reduced my allocation from Indian US stocks from 75 to 60, and I've increased more hedging mechanisms, where basically my hedging mechanisms is almost now 30%, which includes gold, all weather and equity gold, small case as well, physical gold as well, and fixed income instruments in terms of bonds is something that I've invested, and also cash is something that I would call as a hedge kind of a thing, right? Because I'm not deploying it right into the market. But US stocks is something that I feel will generate a lot of alpha for me going forward. So that is something that, fingers crossed, I am betting really well on. So guys, I hope you enjoyed this video, but I have a question to you guys as well. If you have any doubts or any questions related to investment strategies in the year 2023, I'm not a SEBI registered advisor, but you can definitely put your doubts that you might have, saying, Shashank, I have so much allocation in each of these. What do you think should be very appropriate for 2023? So as I've told you, this much percentage of stocks, this much percentage of gold, this much crypto, this much this, I want you to just put in the comment section below, and ask me the question saying, is this good, Shashank? Maybe should I reduce this? And I will answer it in the comment section below. Awesome. I hope this video is slightly helpful for you guys. I'm just trying to understand the global market right now. The minute the global market sentiments start changing, I will start changing my allocation, and that is why it is a very dynamic portfolio. But when I do that, I will definitely inform you guys. This is me, Shashank Udupa, signing off. Take care. See you guys. Bye.